So it says we're preparing the live stream and setting it up, but it always goes live now. So we're gonna just go live now. Justin, welcome back to the channel. Good to see you. Happy Wednesday. Today we're talking about assets,
hmm
something you might know a thing or two about and have a lot of. So we're specifically jumping into our favorite asset type as of now, moving forward. And so yeah, let's jump into it. Welcome back.
Thanks for having me on. Happy Wednesday. Looking forward to our discussion today about asset classes. We were talking about the topic, and I thought it was, yesterday I kind of had an epiphany of, you know, which asset class I'm going to focus on for the year. I'll go ahead and talk about that. And I've been, on previous episodes, we've been talking about asset classes, and I think I mentioned a barbell method where I was doing single families with DADUs in Seattle area and then out of state if I can find a Burr project, a single family one. But now as I'm thinking about it, I still like the single family with detached accessory dwelling unit in the Washington area, just because there's very little space to build, so you're just taking existing lots and adding stuff to the existing lots. But what I've been noticing is that the amount of people that are all focused in on this Seattle proper and more specifically kind of north of Seattle, there is so many people in that area that it just keeps running the prices up. And so I was like, well, my pivot or slash epiphany yesterday was like, there's a market about an hour north called Everett, and they're very pro DADU setup up here. So you can do two DADUs per single family. So if you had a duplex, you could put four DADUs on the lot, obviously space
Wow.
permitting. So I'm
Yeah.
like, it's lower cost to build up here. There's less competition. The ARV is obviously not as high as Seattle, but it's not, way lower. And the rents aren't that much lower than what it is in Seattle. So I'm like, it just seems like it'd be a better fit for me to be, it's like the small fish, big pond, big fish, small pond kind of thing. So
Yeah.
I'm going to start shifting into Everett single family with detached accessory dwelling units.
Sweet. So no more monster houses.
Yeah, yeah. Well, the monster house of mine is in Yakima, where it's just
Yeah.
one house, just all Frankenstein.
Yeah. Sweet. And so how does someone continue to scale a portfolio like that? Because I imagine you can be cash flow constrained on the front end
Right.
for sure. So like how do you scale into a business like that where if you're going to add DADUs or you're looking for properties that specifically have that already, like how are you getting the financing? How are you
Mhm.
sourcing down payment at this point? How do you manage it? What's that look like?
So if I was still in the workforce, i.e., if I was still at Amazon, there you'd always get restricted stock units. So I'd always have like stock. So like what I was doing in the past is I would borrow against my or not my restricted, but the ones granted. So, in the W-2 world, you could do that. Now, post W-2 world, either you got to have some sort of active income. So, like for me, like I have an agent team. But if I wanted to do investing and say I had $0, right? And my goal is to do this with $0. So hopefully in the next, month or two, I'll have a real world example I'll bring to the table here. But the key here is if you find the deal, right? And I always hear you say, I think it's deal, then debt, then equity, I believe is how you say it, right? So if I can go find the deal, that's worth a massive amount of money, right? So then I just need to go find somebody who has money, and I already have two people that want to get into this with me. So literally, it's just a function of how fast can I find that deal. Now, it could be off market. So I have a virtual assistant, she's in the Philippines. I can target that area, have her call, then I have the warm lead, and then set the appointment, get the deal. Or I could go on market, find the deal. Now, me as an agent, I could do that deal. Let's just say it's 3% commission. I could put that money towards my equity into the project as well. So, but really it comes down to if you find a great deal that can make money, other people want to come in and make money because they have money sitting on the sideline. They don't know where to find the deal, nor do they know how to execute the deal. So that's where you can, translate your value into equity.
Let's talk specifics.
Mhm.
How much are you paying for a property like that right now? Not like a unicorn deal, but a typical deal that you're buying. How much money down and how much are you expecting to make per building?
So I'll give you a real world example. We had a client get one. I'll talk about Seattle first, just because we did one on Saturday. So we had a client. It was a single family home, West Seattle, and the lot was just under 6,000 square feet. So before putting in the offer, we checked with an architect to validate we could do two detached accessory dwelling units. The difference between one and two is massive, right? Because if you have two detached accessory dwelling units, if something happens, you're still going to make money. If you only have one and you have a major issue, whatever that is, you could potentially lose money on the deal. So on this one, it was listed at 675,000. I think the front house, I want to say it was around 1,200 square feet. And it was going to have an offer review date. So instead of waiting for the offer review date, uh, worked with the buyer. We put in an offer at 700,000, so 25K above. The seller came back saying, "Hey, it's yours, but we need 715." So the buyer ended up going to 715. So listed 675, went up above 40,000, right? Now
Hmm.
here's where the numbers come into play. So that front house is 715, right? It'll probably go down to, because when you take the back of the yard off, right,
Yep.
you're shrinking the value. So it's at least 10 to 20%. So let's just say 715 goes down to like 650. So you already lost 65K right off the bat when you condoize it.
Yep.
And then in the back, just for round numbers for simple math, it'll be about 400,000 per detached accessory dwelling unit. A to Z, that's the design, the permits, the condoizing, the build, landscaping, all that. So if you have two of those in the back, that's 400 and 400, that's 800. Those should retail, if you were to sell them, about 700,000 each. So kind of round numbers, 300K of equity in each of those if you were to keep it. So 300 plus 300, that's 600, minus the, what was it, 65, right? So it's over 500,000 of equity on that one deal there.
That's great. And so are you going to keep it or are you going to sell it or what are you going to do? Because I imagine initial return that you're getting, you're not going to get that again.
Mm.
It's like
So
it's not going to just jump.
specifically that one's actually for a client. So that client has partners in the deal, and so they're focused on rolling them over. So they then build it up, sell it off, take the money, go buy it again. At some point in time, they'll want to burr these things, meaning actually keep them. So in a perfect world, if you were to do that again, you could have, keep one of the three, in a perfect world, you'd keep the newest one so it has low maintenance, easy to rent. So, but when there's multiple partners involved, they typically want to put their money in, get their money back out. And so that's their plan, is to sell it all and then go take their profits, roll it into another one.
So on a $500,000 upside, why sell it? Why not buy it yourself?
Me as a investor, why didn't I buy that specific one?
Huh?
Yeah, so that's the dynamics of when you're an investor and an agent, right? So then that would be competing with the client. So typically the ones that I'm buying, I'm sourcing off market, or they've been on market for months, right? So that then I can just kind of find something that works specifically for me in my niche, and then where it's not necessarily competing with clients, right? But I'd say the last couple years it's all been off market. So whatever my cold caller gets, I set the appointment, work out the terms with the seller, and then execute on that one.
Sweet. Now, by the way, we did get a question in the chat for you. So from Flavio, I'm fighting the city here in Grandview, Washington. They don't have codes yet for ADU. At Justin, ADU versus selling existing property and buying a duplex.
I mean, if you can buy a duplex that is already set up and you can cash flow on it, that's a great option, right? And it kind of depends on if you have a lot of time and no money, your best route is probably to do the DADU or do the single family, create the DADU in the back. If you have money and not enough time, the duplex might be your route to go. In the state of Washington, though, from what I understand, is that the law that passed back in 2023, that was where basically every single family lot you could add two daddies on it. Now, the caveat there had to be a minimum population. I can't remember the number, so maybe your city fell below that. But what usually happens is like every jurisdiction has a different term for it. Could be an ADU, it could be a DADU, mother-in-law, um, a casita. It just depends on where you're at. But I would talk to the city, see what options you have, and then work through that city to get it done. Or there's other options you can do, and this is, if you can find a lot that has two houses on it already, you could look at splitting that lot or condoizing that lot as a kind of a backdoor approach to it.
Google says that Grandview has a population of just shy of 12,000 people.
That seems like it's too low for some reason 35,000 is what pops in my mind. So it was probably below the magic number.
Sweet. Man, that's bigger than Quincy, where I got started investing. Quincy's only at 8,600. When I bought there, it was in the 7,000 range. It was like 7,400, 7,500 people
Mhm.
7 years ago. That's crazy.
The Quincy, from what I remember, the kind of the takeoff there was related to they're starting to put the data centers in, maybe like 10 years ago, something like that.
Data centers are very helpful. The biggest driver for anywhere over here is that we have the cheapest power in the country.
Hmm.
So that's conducive to having data centers because
100%.
they use a lot of electricity and a lot of water, is my understanding. And we have a lot of both of those. So that's good. All
You
right.
specifically, we were talking about assets. What's the main one that you're focusing on right now?
Right now, I'm focused on new apartments and townhomes,
Hmm.
not the value add, no single family, but I'm doing a lot of new stuff is where my focus is. So I'm working on building a quadplex on one of my lots. I'm working on building a 10plex on one of my lots and a 21 unit on another. Not all at the same time, of course, but that's the focus for the next 18 months. The reason being, even though there's a lot of building going on in my market, there's going to be some temporary pain for myself. But it is, even Zuber's talked about it. It is hard to get into new construction. He hasn't done it yet.
Hmm.
And so I am trying to do the hard stuff now, suffer now, so that I get to own an asset that has those benefits for the long term. And I've done a lot of brain damage. I mean, you can see every
Hmm.
once in a while, I get these little spots from the stress of building a big convoluted business. And so part of simplifying and optimizing my business is now going into the new construction. The return on equity is a little less. It's not much less when you account for like maintenance and stress factor, but it's more stable.
Right.
So I really want stability. As Robert Kiyosaki would say, that's probably the middle class mindset that's in me because we all have it in us. But I want stability. So that's what I'm pushing for.
I totally agree with you. I mean, if you look at what I sold in the last 2 years, were all my lower income, high turnover, older properties. And this sounds funny, but I was selling stuff that's over 100 years old, and now that I'm buying stuff like the one I just bought in January, I want to say it's in the 70s. I'm like, that's pretty new for me, right? Because that's like, over 50 years younger than what I had. Um, you know, Typically the stuff has already been upgraded, versus when you have these old properties, they're galvanized pipes, they have the knob and tube and old roofs and all that. So there's a lot of capex going into there. There's a lot of turnover. And the tenant base really doesn't take care of the property like these newer properties. So I get it, man. I'm like, how can I get into bigger, better, stable tenants? Because that's way less stress on the cash flow in the pocket.
Yeah.
Um, so, and I guess if you're focused on return on time, there's a lot of time that goes into replacing tenants, right? So if you don't
Time
have
and
good
money.
tenants, yeah.
Yeah, it's a lot of time and money. And I get I'm gonna earn like 3 to 4% on equity in the first couple of years, which is kind of lame. But as rents continue to rise and Washington continues to get more unaffordable for single family, like buying a house in Moses Lake costs you a couple thousand a month when you account for maintenance and utilities and all that, just for a basic 1950s house. It's like
Right.
you want to do that, or you want to just rent a nice townhome for a
Mhm.
little less. Like I see the rents continuing to rise, and then that'll help boost the return.
What are you planning on, back to how you're going to use your funds to do that? Are you going to sell your some other buildings and try to 1031 into it? Are you going to take on debt partners?
I'm looking at selling some stuff. However, now it's not the most ideal time to sell, just with how everything is performing. It's winter, and valuations are down, I think, across the board for most folks in apartments. So it's not the most ideal time to sell. If it sells, I'll take the money, I'll shove it into the new stuff. I'll have more predictable returns instead of getting a 6 to 8% return on equity with a whole bunch of stress and headaches. I'll probably get a 4 to 5% return, but that's still enough to chill.
Hmm.
So, yeah, I'll do it. More realistically, though, I will refinance because I have some lenders, and by some, I mean one who's in the fives right now for apartments.
Wow.
High fives, but fives. And so I'm looking at refinancing and repositioning some of my debt stack into that, whereas my average rate's in the sevens, push it into the high fives, and then just increase my cash flow. If it doesn't
Hmm.
get to the end goal, my thought process is I'll increase my cash flow
Hmm.
and I can take on a strategic partner to get into the new stuff. And when the time comes and values are up again, because it's just a matter of how long do I have to wait, pull out money from the assets, buy out the partners, and then I own both. I got the bottom end and the top end. And that's more realistically what's going to play out.
I love it. And then on those, you would bring somebody in, and then the similar as you've done in the past, you'd have a buyout clause. Is that what you're thinking?
Likely, yeah, have a path to sunset them.
Hmm. Yeah, one thing, as you're building that out, and this is as I was doing my first one, it it's actually takes a while to do all the soft cost stuff. You got to get the survey, you got to get the architect, you got to get the permit, you got to, depending on the lot, do you already have utilities? You got to bring utilities there. And then there's all these impact fees, right? So have you got into it on like how much it's actually going to cost before you even uh, do anything to the physical lot, like even before you get the foundation dug? Do you have a rough number on what it's going to cost you?
For the ones where I'm just buying the dirt to build it, yeah. Most of my projects, though, are on existing land. So I bought two houses on one lot and it had room to build a fourplex on the back. So that's a project I'm pursuing. I didn't do all the math when I bought it. I was just like, I'm gonna build it someday. Same with my sixplex. My sixplex, I'm gonna be putting 10 townhomes on the back. I didn't do all the math to build it because by the time I'm building it, it's gonna be different. The costs are gonna go up.
Mhm.
It just happens.
Nice. And then you've been I'm imagining, because I see you, some of your past videos walking in front of some development complexes. So you're making connections already with those builders and developers.
Yeah, you gotta meet with people who've done what you want to do.
Hmm.
We got a question from Alex, the accidental landlord. Good morning. The fourplex I'm interested. It's listed for 1.4. Owner is looking for seed money. I have 240 for a down payment. What are some options to finance it?
Good morning. There's a fourplex I'm interested in. Listen for one. I'm just reading it here on the phone. Just
Yeah, 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 yeah.
what are some options to finance it? I mean, this is like your bread and butter on that. So I always like to see like first, if you can work with the seller first, right? Is there an
Yep.
option to do seller financing? And some of the simple questions, and this would be good to see how you do it. But I'm like, what are you going to do with all that money? Have you figured out how you're going to plan for all that tax impact. And then I like to see what they say from there. If they say like, oh, I've already got a plan for it, or I'm going to 1031, they're probably not going to want to seller finance. But if they're like, yeah, I haven't thought about that, and there's no way that I'm going to give the government that much money, that's a prime candidate of trying to work through a seller finance deal. I mean, how would you go about that conversation?
Well, there's a couple ways you could structure it. There are DSCR loan products that accept 15% down if the seller finances a second mortgage.
Hmm.
15% down on 1.4 million is going to be less than 225. Let's see. Yeah, 210.
Hmm.
You have that. So if the seller was willing to finance some money in second position at a low rate to help your cash flow work, you could find a DSCR lender and you could buy it with the cash that you have.
Yeah, that's the Dow, something Dow, I think. Jonathan Dow. He does the 50-40-10 on Michael Zuber's channel.
The
Uh,
problem with that structure, though, is their rate is so high. It's
uh-huh.
so incredibly high that it kills majority of deals.
Uh-huh.
Even with the seller second being at a nominal rate, there are DSCR loans where you can get in the 7 to 8 range rather than the 8 to 11.
Hmm.
And you can have 30-year fixed, 40-year fixed with 15% down. So even though you can get that extra 5% leverage, it would be probably wise to look into getting the longer term, lower rate loan product.
On that specific property, it's a fourplex. So that's like 350, roughly 350,000, I think, for per unit. So one of the questions, was it Andrew or Alex that asked that? You'd have
Alex,
to- Alex. So you'd have to figure out what is the rental income on that to see if it's even gonna be able to cover the debt. So I think Alex is over in Bremerton area. So, if it's 350,000, my guesstimate, they're gonna have to have rents of like at least 2,500 to 2,700 to make it make sense.
yeah, which is possible, definitely possible.
Yeah, so they'd have to probably be at least 3 bedrooms and decent location for Bremerton.
Let's see. We have some people asking when they're getting to Vegas. Getting to Vegas on Friday.
Yeah, Mark's already there, it says. He says,
Oh yeah, there he is. Didn't see that one. Someday we got to do a call with all of us. Got to get Mark on here.
exactly.
When do you fly in?
I get in Friday night, 9 p.m., and then I'm leaving Monday morning.
Sweet. Yeah, I have to leave Sunday. My travel days are extra long because I'm 3.5 hours from the airport. So that sucks.
You going to Spokane or Seattle?
Seattle.
Yeah, okay.
Yeah,
Yeah,
we have pets, so we drop them off on the west side and then go from there.
yeah. Yeah, this trip to Vegas is super expensive. I think it's because Valentine's Day landed on the same weekend. Typically, Valentine's kind of middle, the last couple years was kind of middle of the week, so it didn't impact necessarily the travel to Vegas. But man, I'm paying like 850, which is like double what I normally would pay to go to Vegas. So, but gotta go. And because it was so expensive, it was actually the same amount because I live up by Everett, an hour north of Seattle. So I'm actually flying out of the Everett airport, which is going to be my first time going to out of Everett to Vegas and back. So I can take an Uber from my place up in Snohomish over to Everett, hop on the plane, and then Uber back. So that's going to be a new experience for me.
Let's see. Alex said he needs cash to launch a business. I will caveat that with you don't need that much cash to start a business. Every business that I've started that was successful, so I've definitely started a couple that weren't, but the ones that were the most successful started with no money. Started with an idea, brought the idea out to people, which is the market, got commitment, brought money in, and then scaled. But don't go spending a ton of money. Is my recommendation. At least that's if I were in your shoes, you know, talking with them, you don't need a lot of money to start a business, typically.
That's one in my MBA class at Berkeley. I was one of the things that they talked about is as fast as possible, get proof of concept. So like get something really scrappy, try to generate sales on the minimal viable product.
Right.
Once you get that proof of concept, now you go take it to somebody who you can prove that, hey, we've got traction already. Then bring the money in versus, sometimes you see people like, oh, this is a great thing. And they spend, a lot of money building it up before they've actually tried to sell whatever the product or service is.
Yeah. We got another question. What do you guys think about the 1% rule?
hmm So the 1% rule, when I was started investing, there's times where I was getting like the 2% rule. I mean, today's world, it's not nearly as possible, but in Milwaukee specifically, because I was buying stuff like 60 to 80,000 for a duplex. And now these, the ones I was telling you about, 100 years old, C class, D class, total blue collar type stuff. They were 60 to 80,000. They're renting for each side for a two-bedroom be six to 700 each, right? So that would be, 12 to $1,400, right? So if I'm buying that at 70, 70,000, 1,400, I mean, that's the 2% rule, right? That's like a no-brainer. And at the
Could be.
time, like I was getting 3.5% interest rate. So it's like I literally didn't even have to crunch the numbers. Now, the biggest factor on those ones was, well, how bad was the condition of the house? Because like there's a reason why they were that cheap. And so I was like, okay, is it going to be 10,000, 20,000, 30,000 in the first, couple years as the tenants turn over, new roof and ripping out the electrical system, water systems. That was the big ticket items that I didn't realize at the beginning. At the beginning, I was like, oh man, this is amazing. This is a no-brainer. As I started getting more and more of those and they started to, have issues, that's when I started wising up to that stuff.
Yeah, and I don't really care for 1% rule, 2% rule. Like, it doesn't matter because you could have a 1% rule in Washington and a 1% rule in Texas and have completely different returns if everything else was the same.
hmm
Taxes, insurance, it all adds up. And the other thing is, if you buy on a 1% rule or a 2% rule, like you mentioned, it was a no-brainer. I wouldn't buy that deal that you mentioned. That was even a no-brainer because I don't see any money in it. Even if your cost of capital is really low, once you account for the capex, you account for the maintenance on a property like that, like the maximum amount of income that it could make is $1,400 a month.
hmm
If 35-40% of that goes to expenses for standard operations, and then you account for the upkeep, it's like there's not a whole lot of money in that. Even when you get it paid off, Dave Ramsey talks about that a lot too. Single family and duplexes don't really cash flow a whole lot unless you're in super expensive markets where the rents are incredibly high and they're paid off. So
Right.
even
That's
that,
definitely as I got into it, like I went on a spree and I did a ton for a couple years. All of them were about the same size, two to four units.
yeah,
In hindsight, yes, more units under one roof, faster, right? Which is you went that way day one, right?
right.
So in hindsight, yes. Because then basically what you're talking about, there's just more money coming in the door. So and there's your percent, if one is offline, i.e. somebody moves out, on a 10 unit, you're only losing 10%. On a duplex, you're losing 50% of the income, I think is what you're getting at there. So yes, like in hindsight, knowing what I know now, going into the Midwest, I would have scaled up faster to bigger units, or not bigger units, but more units under one roof to then help the cash flow when there was the capex things, because they're all going to have some sort of capex at some point in time.
Yeah. And it's really sad. I just had a tenant die,
Mm,
pass away. That happens a lot when what I found, you get into the lower income bracket apartments and you scale to a lot of doors, you just experience a lot of death. But they passed away. If if they had passed away and they were in a single family rental, it would have been financially devastating.
Hmm.
But it's in a 39 unit apartment building. So while it's equally sad, the financials don't really get burdened a whole lot
Right.
because of the scale. So I'd rather get a 20 unit that's not a 1% rule deal than get a house or duplex that is a 1% rule deal for
Right.
that reason. It's just less exposure, less risk on the
Mhm.
vacancy front.
Yeah, you're looking at it at holistically, and I think where people get in trouble on the 1% rule is they would buy something just because of the 1% rule. Where when I was analyzing these properties, like I would literally scroll through Redfin, there'd be like 20 a day would come in. I would just kind of scroll through, look at the rents, 30 seconds or less to analyze, right? And the 1% rule is like a just a filter. Then if it hits the 1%, then I dig into it. Okay, now I look at the pictures, I look at the area, I talk to the agent. I'm seeing what kind of CapEx issues are there. So if you use that 1% rule as kind of a filter, I don't see any issues with that. But like what Cody's saying, you can go wrong with getting a 1% rule, right? There could be a reason why there's the 1%. So that to me, if you use this as a filter, as a you know predictor of, hey, this needs more time and effort to analyze to see if it's a good deal, you can't go wrong with that.
With that, Victor said here in Mexico, I build a rent and get 1 to 2% rule. It's great. As long as the returns work for you, and that's what matters most.
From what I understand, I've known some friends that have invested in other countries. From what I've understand there, it's not as friendly on lending. So I had a friend buy in Costa Rica, and I want to say the max loan to value they would do down there is like 50%. So can you do build in these other countries and buy in these other countries? Yes. But just the loan to value, the cultural norms, the banking norms are much different than the US. The US is pro building, pro lending on real estate. You can, we can, if you live in the property and go as low as 3.5% down, right? Like 96.5% lever. But when you get into these other countries, the amount that you can borrow is way less. So either Victor is got a money partner, has a lot of money, or he's just saving up and doing all this out of pocket. From what I understand, it's pretty hard to expand into these other countries to get the right lending setup.
And it's worth noting the deal could be a higher return than, like, let's say Justin has a higher return deal than I do. If I have a better leverage, if I have a better debt product, I can get a higher realized return, even though his deal will produce more. I think that's what you're hitting home on. Even though it could be a 2% rule deal, if the leverage doesn't allow you to get in at a good point, you could buy a deal that's not even a 1% rule deal and get a higher return on your investment.
Yeah, he just said, correct. All my properties are paid in full. Very difficult to finance. Yeah. So I get that's when you're in countries that aren't established and have, monetary issues. What is it like? Is it Brazil? There's some of these countries where like literally the value of their local currency just inflates away like literally overnight. So the last thing people want to do is lend money that's almost literally worth less the next day. So that they're probably not going to want to lend in those type environments.
For sure. Well, do you have any closing thoughts on assets? You like single family with the DADU. I couldn't be farther from that. I love apartments.
Mhm.
So, do you have any closing thoughts for folks?
I would just go back to I was watching your video yesterday with Mark, and it was talking about, what should be people be doing, on if they're looking at their next investment property. And basically you summed it up saying just do the same thing for 5 years. Because those 5 years you're going to figure out how to get better and continue to hone in on your investment strategy. So like for myself, right? I just did my first single family dadu project. Took way too long but learned a lot. So now I'm want to take that learning and continue to replicate it over and over again for the next couple of years, hone that in, get better at it, figure out how to get better deals, better costs on my build cost, the financing of it, and then how do I, rinse and repeat this so that it's more of a systematic process versus, this first one I did was a lot of heavy lifting because I was learning everything at the same time. So as you move forward, there's less learning and the friction becomes less and it's easier to do more deals.
Sweet. Well, I'm excited to see you this weekend. Safe travels. Be good to
All right,
connect
man.
with you and everybody in the comments here soon. We'll be playing catch up to get over to Vegas to say hi to Mark. But it will be a lot of fun. And yeah, thanks for jumping on today.
No problem. See you on Saturday morning.
See you.